FRS 102, Lease Accounting, Don't Let Tax Catch You Out. Today we're talking about the tax consequences of the upcoming changes to FRS 102 Lease Accounting. The accounting side gets a lot of focus, but tax, that can too easily become an afterthought. Let's break down why tax needs to be part of your lease transition plan from the start. The change to FRS in 102, Section 20, and Taxation, the change in a nutshell. So what's happening? Under the revised Section 20 of FRS 102, leases will come on balance sheet. In simple terms, businesses will show lease liabilities and right-of-use assets. No more burying lease details in the notes. This brings UK local reporting closer to IFRS 16. It's a big shift in how leases appear in your accounts. What most people miss. But here's where people can get caught out. It's not just the accounting presentation that changes. The lease costs in your accounts will shift, often front-loaded. Yet for tax purposes, the rules often stay the same. Tax relief is still based on the actual lease payments made, and that creates a timing mismatch. Your accounting profit goes one way, but your taxable profit doesn't follow. That's where deferred tax creeps in. And our tip for today, under the new rules, finance will classify all qualifying leases as right-of-use assets. However, it's important that internal records clearly distinguish finance leases from operating leases, because the tax treatment can vary. Taxation impacts and why timing matters. Common tax impacts. Let's look at what we often see on projects like this. You'll probably end up with deferred tax balances because of those timing differences. Right-of-use assets. In most cases, they won't qualify for capital allowances, so no extra tax relief there. Your taxable profit might stay high in the early years, even though your accounting profit looks lower. And for groups, that could affect your loss planning, group relief, or cash flow forecasts. Why timing matters. So, what's the big message here? Timing matters. If you leave tax until the audit or the year-end close, you risk last-minute surprises, maybe even extra tax payments or tricky questions from HMRC. Tax should have a seat at the table right at the start of your lease accounting project. It's part of managing the change properly. What you can do now. Talk to your tax team or your external advisors. Map out how the accounting changes interact with your tax position, and forecast that over the life of your leases. If you're using software, make sure it can handle both the accounting and tax reporting. And don't just focus on getting the balance sheet right, look at the full picture. So, in summary, lease accounting and tax are linked. Don't wait until audit time to raise the red flag. If you're planning your transition to the new FRS 102 standard, make tax part of your project management and visit the Knowledge Hub on our website at Lease Solutions Pro if you need help scoping it out, and for real-world tips and more. Click like if you found this helpful, comment with your thoughts or questions, and share with friends or colleagues who may be navigating the same challenges. And don't forget to subscribe and stay tuned for more insightful content, helping you get it right with confidence.